to Friday at 12:30 p.m. only on Bloomberg Quint.
Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gives you a complete wrap of all the stocks that are buzzing in trade. I am Darshan Mehta. Let's welcome our experts then Chintan, Vora, Finance.com, Foram, Parekh of Indiabulls Ventures and Yogesh Mehta of Motilal, Oswal, Securities join us on the show. Today on Hot Money, we'll discuss the numbers that Eicher reported. The counter has managed to move up in trade today. Cement, as a fact, has been reporting disappointing numbers. What's the view on cement going ahead? Is it the right time to start accumulating Voltas? And we analyzed Britannia's second quarter number, the last FMCG company to report numbers. But let's start with the first one, and that is Eicher Motors. Now, the counter came out with numbers which managed to disappoint, but news reports also coming in that the strike at one of their plants is almost over now and work will resume, and that's why the counter has managed to inch up in trade today. But overall, how were the numbers and how does Eicher Motors fit into the two-wheeler pack in terms of pecking order? We'll ask our guest. So Yogesh, I'll start with you. What did you all make of Eicher's numbers and what are you all recommending clients to do post seeing these numbers?
Yeah, Darshan, the numbers are very much in line with expectation. There is no dent into any of the numbers, maybe be it margins or be it a top line or a bottom line number. However, the marketing spend has increased because of the new launches which has happened with a global way. So that has done some kind of a 130 basis point margin, but overall it seems that 580 kind of a PET growth, PET numbers are very much in line with expectation. And there was other expenses as well, which has given an EBITDA margin shrunk of around 40% gross margin. So we believe that numbers are very much in line and expansion plan is also there. The new launches are coming up and the now strike is also over. But what we believe is that VE, CV and RE both together, now fair valuation has come down, not significantly, but it has come down a bit. So now we are projecting 26,350 as a price target with valuation multiple we have revised on the lower side. Okay,
and among the pecking order, what are you all recommending clients? If you have to recommend the two-wheelers, what are you all recommending to do?
Two-wheelers, we are going to go about Bajaj Auto because of the Pulsar launching and the KTM, the way it is getting more and more popularized in the sports and sports biking segment. So that we think that valuations are very much attractive there, and the numbers are also doing very well with 5 lakh plus kind of since last 5 months, 6 months or so.
Okay.
So we believe that Bajaj Auto has better.
So Bajaj is the top pick among this thing.
Top pick.
Okay. What about you, Chintan? What did you make of Eicher's numbers?
So I'll go with what Yogesh just spoke about. The numbers are pretty decent. I mean 6%, 5.9% kind of a growth in terms of overall numbers. And the overall revenue also going up by approximately 11.9% is not bad at all. So when it comes to the results, we are very neutral about the results. The good thing is that lot of headwinds that Eicher Motor it faced. The strike which happened. There was a lot of revenue loss because of strike. Almost 25,000 units was the loss which they identified. Moreover, they are also coming up with the greenfield project at Bhopal. So all these things put together and overall looking at the sentiments of Indian youth, it is going to do really good because it has got now a good blend of a commercial vehicle as well as a two-wheeler space, kind of a portfolio in itself. So not only looking at the numbers and saying that it is going to dent the profitability, the results, even if you look at the prices at this point in time, exactly a year back we saw the same kind of a price. So this could be a good time to accumulate Eicher Motors gradually, and result is not really going to matter much onto the stock.
What about valuation? It's not the cheapest among the two-wheelers. So given the fact that competition is also coming in and they have their expenses with respect to the export markets now, will such valuation sustain given that the growth now isn't as much as it used to be? The base is becoming much higher.
That's right. So you rightly identified. See, when it comes to valuations, if we take PE as a base, it's certainly much cheaper than TVS Motors for that matter. But ideally, way too very expensive than what its competition like Hero MotoCorp is. So valuation-wise, it is not way too very great valuations, not a sustainable kind of a valuations. We expect there is some dent in valuation which is for sure to come in. Because it's not only a game which Eicher will have to play in the segment. there is Bajaj which is coming up with its own variant, and there is Hero at the same time which is coming up with its own variants. So what appeals to youth is now getting distributed amongst various stock portfolios. I mean, various counters, then only being concentrated to its bullet segment by Eicher.
Okay, what about you, Foram? How did you all find the numbers? What are you all telling your clients to do on Eicher Motors?
So the numbers are of course very good. There is no doubt about it. On every parameters, the top line, the bottom line. In fact, the market share is also increasing in the motorcycle space, and it has retained is more than 90% of the market share. And yes, we are seeing a little dent on the commercial vehicle side. The market share of the commercial vehicle side is decreasing. Of course, not significantly, but yes, it is on a declining side. So I feel that, of course, as we discussed, valuations are very expensive, and at current juncture, we do not want to give a premium, valuation to the stock. So I would say that one should definitely shift from Eicher Motors to Bajaj Auto, because no doubt there's nothing wrong in the company, but only from the valuations per se. We like Bajaj Auto more. Why? Because Bajaj Auto is gaining market share now. We have seen good increment of market share from, I guess, 12% in the motorcycle segment to 17%, which is good in a year's time for Bajaj Auto. And Bajaj Auto is doing good in the low segment, lower segment, in the premium segment, everywhere. Now, Bajaj Auto has its own strategy of cutting down prices in the lower end and keeping the prices at the premium end segment. But I think that valuations are also very attractive, and it's doing all the right thing, Bajaj Auto. So I would want to skew more towards Bajaj Auto, then keep on giving premium valuations to Eicher Motor.
Okay, so that's the view that's coming in on Eicher Motors. I think valuations is something that all of our guests have spoken about, and it seems that Bajaj Auto seems to be a preferred pick at this point of time. Moving on, cement as a pack has not done well. Most of the cement companies have disappointed with their earnings. But what's the view? Are valuations now attractive? Should you start nibbling into certain cement counters? That's what we're asking our guests. So, Foram, I'll start with you. Among the cement, which is the top stock that you are recommending to your clients?
Yes, as you rightly said, cement as an entire pack did not rally for a very long time. So we would want to stick with the market leader, and that is Ultratech Cement.
Okay.
Now we have seen that after the JP's acquisition, so they have increased their capacity also, and there are news that it's going to now take Century's cement segment also. So that would also augur to its capacity. It would give it regional diversification out of this acquisition, and of course valuations are also very attractive. It's a market leader, so it's reporting very good set of numbers on the top line, EBITDA level, and again it's doing all the right things, and seeing that it's now venturing into renewable energies, so that would also lower its power and fuel expenses, which would in line increase at the EBITDA margins. So we feel that Ultratech Cement is something we would want to go right now.
You all have active coverage on Ultratech?
We do not have an active coverage, but we do track the stock, and we feel that this stock can give you good upside of like 10%. It can very well give you 4,000 and above levels, from the current juncture. And valuations, as I said, is also very attractive. I guess $180 to $200, EV by ton. So on an FY20 basis. So I think on every parameter it's good, and with there's a demand in the sector also. We're seeing infrastructure demand being picked up, and we're seeing that housing prices, the lower end of the housing cycle is also, there's a pickup in the construction over there. So cement demand would be there, and I think we should rightly enter at current level.
Okay, Yogesh, among the cement companies, what are you all recommending clients?
I agree with Ultratech on the large cap side. With the conservative investors said, we have a buy rating on majority of all the cement. What I like most is JK Cement, where you can have a dual play on white cement and the grey cement along with the wall putty, which is now the trending for ongoing next 3 to 5 years. Okay. 10.5 million ton capacity for grey cement and 1.2 for white cement, as well as a wall putty of around 1 million. So what we believe is that the first half performance was not so good because of the cost inflation, the high depreciation and all together. But the best part is they're increasing their capacity by March 20 as scheduled. So it is just 1.5 years down the line. The March 19. So that will happen, and it will be incremental, go from 10.5 million ton to 15 million ton. So that will add to EBITDA per ton from 810 rupees right now to 920 rupees per ton from the next year onwards. The utilization is 84%. The total utilization is 84% capacity utilization, and all this together, we believe that a trajectory for upward move for JK Cement is very much likely because of the capacity expansion, and that should drive the profitability for investors as well.
Okay, so you all have a buy across the board. Are you all telling someone to avoid any of the cement counters?
To avoid is India Cement and maybe one or two more, but largely it is neutral. Dalmia or the Shree Cement or the Ultratech all are on a buy side. The avoid or neutral would be India Cement one.
Okay, what about you? What are you looking at, Chintan?
See, overall as a sector, not too very greatly bullish onto cement as a sector, because the kind of a potential which a cement sector will cap is not more than probably 10 to 11% kind of an upside on a sustainable basis. So if I have to choose, my favorite of the entire pack, that's again going to be an Ultratech Cement, one being a clear market leader. That's one of the reasons. More to it, after the integration with, JP Associates, it's really unfolded, I mean, a great lot of, volume growth. What is more disturbing into the entire sector is there's a lot of, rise in the energy cost, the fuel cost, even, in the logistic cost, which is still keeping, a lot of pressure onto the entire sector. So despite, a very good volume uptick that we have seen in the entire cement sector, the profitability is still taking a lot of hit. So a very neutral call on the entire cement as a sector, but if one stock that I need to picking up is Ultratech Cement.
Okay, so I think that's the consensus view that we are getting in. I think Ultratech features among, an accumulator rating among all three of our guests, and in particular, Motilal Oswal Securities, they like JK Cement at this point of time. So that's the cement view. Chintan is neutral on the cement sector at this point of time. The next topic we want to talk about is Voltas. Now, numbers were not the best, and the counter has off late corrected significantly from the recent highs that we've seen. Obviously, competition is one of the main reasons why there seems to be a lot of traction, against the unitary cooling business that they have. But that's the biggest growing part that they have at this point of time. But is it the right time to start accumulating Voltas, or should you be cautious on them? We'll ask again. Chintan, Voltas, do you like the company?
Okay. So, it's been a real roller coaster ride for Voltas when it comes to, the price movements and even making a real good decent incremental value or even dividends for the end consumer. To start with, currently, it's not a very good time that we venture straight away into Voltas, primarily for a couple of reasons. One, the input cost has already gone up by approximately 10%. That's first factor. More to it, the hit again comes in is wherein the custom duty is already hiked from 10 to 20%, right? So these are the two factors which is going to dampen the sector slightly from here on. Look at the positives of the Voltas. It's already got, close to 25% plus kind of a market share in the business that it forays in. Also, the plan to reach tier 2 and tier 3 cities is going to give a very good booster to the entire as a sector. So overall, one view at this point in time onto Voltas is that yes, it is a good counter to buy, but only buy at dips at this point in time.
Okay, buy on dips is something that you are recommending, Foram. You agree, or what call do you all have on Voltas?
Yes, I absolutely agree to what he said, and we also feel that we might get it at a lower price, and the strategy would be buy on dips. But as if we look at the results, as you said, the ultra cooling segment is featuring a lot of headwinds across the industry, but its other segment, the electromechanical, that is doing very good, and that only for that segment, I think I would want to go and give a buy at current price. Why? Because this segment has a major pie in the revenue, and I think 63% of the total revenue comes from this segment, and that segment itself is growing at a good pace. So when a larger pie is doing good, it gives us a breather and confidence in the stock, and that is why we would want to go ahead. Again, the market share of the company is increasing, which is very important, and secondly, of course, I think the negatives are discounted at the current price, and valuations also very attractive. And if we look forward, we have a good Q4, which is their strongest quarter amongst the year, in the year. So on the forward basis, I would want to go ahead and give a buy call at the current price for Voltas.
Okay, what about you, Yogesh? What are you all recommending your clients on Voltas?
Voltas per se, we have a neutral rating on that because of the valuation multiple. Though the results are very much in line with expectation about the UCP margin has dented because of the lower tax. The lower tax has given some kicker to that. So around 100 billion rupee was the profit. But if you consider then other income was on a larger pie, 15 billion rupee, and as well as the tax was 5% lower. So that has given a booster to PAT numbers. But UCP margin dented by almost 2.3 percentage points. So that is something which is worrisome. And EMP division is doing well. That has done very well at the 14 billion rupee of a top line. Then we believe that overall positives can happen only if the Voltas Beko JV, which has turned up now, so they will start from selling all the electronic appliances from immediately next quarter onwards, or maybe the March 2019. But ultimately it will be all imported right now. So again, INR needs to be seen what would the impact ongoing. There is a question mark. If the inverter AC works very fine with them, and if that turns positive for them, then we can have some review on the rating right at this point in time. So it is Sanand facility, they will shift Voltas Beko, but it will take some 1.5 years down the line minimum. So it is the rosy blue scenario is there, but it is far from the horizon right now. So we are just waiting for that, and we are valuing this company at around UCP as well as the EMP both divisions. So it is fairly valued at 510, 520 rupees right now. So there is no much upside left for till FY21 and a half years.
Okay, so I think the consensus view that we're getting is fairly valued and should be accumulated only on declines at this point of time, and not at the current market price. And finally, the last stock we want to talk about is Britannia. Now, counter has corrected significantly from the highs that it was, but still not the by far not the cheapest FMCG space, and most of the FMCG counters are expensive in trade. It's moved up 20% in the last 12 months, but remember in the last 3 months there has been turbulent time. It's down almost 11%. Foram, valuation wise, would you buy, and what did you make of the numbers?
Yeah, so again, valuation wise, I would not go ahead and buy at current levels. But if we talk about the Q2 numbers, they are very good on every parameter. I again do not see any dent in the numbers, the top line growth, the margins, expansion, bottom line growth, everything is there. I think the company is also growing at good 10-15% upside. And but the only thing is, valuations are exorbitant. We do not want to go and give a premium valuation when other stocks are trading at, attractive valuations. So I would want to shift my focus from Britannia to say ITC for that matter. Okay. ITC, if we see, all the cigarette and the non-cigarette business, all are doing very good. The hotels, the agriculture business, everything is doing good. So I would want to go and shift towards, ITC rather than buying Britannia.
What did you make of the numbers?
Yeah, so numbers are good, they are seeing good tractions, and I think top line also grew by good 10-15%, and margin increments are there, and bottom line also grew by 10-15%, and management is also, confident about the demand per se and everything. So only thing is, valuation is something that is a little sign of worry, and that is why we would want to shift to ITC.
Okay, shift to ITC. Chintan, Britannia, what did you make of the numbers?
Okay, now numbers were very much in line with what was expected. Okay, there is not a great change that we are seeing in numbers or a great booster. The reason being very simple, some pinch of inflation which has just come in. But again, it is not taken a lot of it in terms of revenues, because the numbers have done decently better. So talking about the result were almost at par, and we don't see a great change in the valuations purely because of these particular results. What I see at this point in time on the valuation front is, yes, the stock is little more expensive, but what matters to the end investor when it comes to investing into stock is not only whether the stock is expensive on one of the multiples. It also matters that what is a kind of an uptick in the stock prices, or what is the kind of a business model. So when the stock was trading approximately even 300-400 rupees higher from here on, even at 6,000 odd levels, the stock was still attractive to the investors, to the analysts. To us at this level, again we see a lot of attractiveness into the stocks purely because of the business model that it has got, the premiumization of the products that it is getting in. The food processing which is at Food Tech Park, which they are getting in, and also the greenfield project which is coming up in Nepal. Right, this is all going to give a very good booster. any which ways, today Britannia enjoys almost 33% of its market share in the biscuit segment, and with all this diversification and you know the multi-digital marketing platform, multimedia marketing platform that it is adopting, the revenues are only, you know, we see going up from here on. So it will be a good time for us to have, you know, Britannia as one of the portfolio stocks.
Okay, but what about you, Yogesh? Agree? What are you looking at? Growth or valuation in Britannia?
Of course, it will be the growth will be very much 10-12%. We cannot foresee or we cannot project 50%, 30% kind of a growth in this kind of a company. But 10-12% sustainable growth. What we believe is that, and what we are projecting is that Britannia, this is the 4th consecutive quarter they are doing double-digit growth. So that is fantastic. Second thing, this is the highest ever margin of 15.8%. Whatever the cost inflation has happened, they have easily passed on to the consumers. So they haven't got any dent in the margin. Gross margin is around 40%. The facility of the own manufacturing, the continued investment in R&D, all these are showing good confidence in the management itself. So apart from these two analysts have given the view on the valuation front, I believe that valuation wise ROE of 35 and 40% company with ROC of equal 35-40% and a growth of 10-12% on the top line numbers as a volume growth, one should look at not only the growth path as well as the valuation. It should be fairly benchmarked towards the consistent earning growth.
Okay.
So that will happen only in Britannia.
So what rating do you all have on?
We have a buy rating. We have a topic into the FMCG sector as well. We believe that continuous premiumization will also happen, and they are launching new products in the biscuit segment. And now Parle-G, if we compare the market share or wallet share of Britannia from Parle-G, that has also improved sufficiently from FY13 to FY18. So that should play out well for them, and you will not have any sleepless nights in Britannia if you have invested into.
Okay, so that's the view that's coming in. I think we got different varying views that have come out on Britannia. Yogesh as well as Chintan like Britannia even at this valuation, but Foram is saying shift to an ITC because valuations certainly seem to be on the expensive side. But with that, it's a wrap on today's Hot Money. Foram, thank you for coming in. Chintan, Yogesh, thank you so much for coming in today. Ask BQ comes up next. Stay tuned to Bloomberg Quiz.